When it comes to investing in the stock market, most people think you need to have the predictive powers of a crystal ball gazer, the nerves of a bomb disposal expert, and a caffeine addiction that would kill a horse. We are led to believe that asset allocation is a complex, mysterious, dark art practiced by guys in Midtown Manhattan who wear fleece vests and charge you a 1% fee just to move your money from one pile to another. They tell you to analyze the market conditions. They tell you to rotate your sectors based on the geopolitical climate of Eastern Europe or the rainfall patterns in South America. They tell you to constantly buy and sell based on whatever the Federal Reserve Chairman had for breakfast that morning. And usually, trying to micromanage your portfolio like this results in the exact same outcome. You panic when the red line goes down, you sell everything at the bottom because you are terrified, and then you buy it all back at the top because of FOMO. You end up buying high and selling low, which is the exact opposite of the point of the game. The pain of trying to pick the perfect portfolio is that it is exhausting. You are constantly second-guessing yourself. Is tech overvalued? Is real estate crashing? Should I be in gold? You spend your life glued to financial news, which is mostly just entertainment for people who like to lose money. But if you want to build a portfolio that grows when you are young and protects you when you are old, it is actually easy. You don't need a financial advisor, and you definitely don't need to watch the news. You just need your own birthday and a simple subtraction problem. You just need the 100 minus age rule. So why is this rule the golden standard of lazy investing? The logic behind the 100 minus age rule is based on the concept of time horizon. To explain this, let's use an analogy. Imagine your investment journey is a race car driving on a track.
Stocks are the gas pedal. They are powerful. They are fast. They are the engine that drives your wealth forward and compounds your money. But because they are fast, they are dangerous. Sometimes the car spins out. Sometimes the market crashes and the car hits the wall. Bonds, on the other hand, are the brakes and the airbags. They are boring. They don't make the car go fast. In fact, they slow you down. But when the car hits the wall, and the market always hits the wall eventually, the bonds are the thing that stops you from dying. They keep you safe so you can finish the race. The math is actually simple. It looks like this. You take the number 100 and you subtract your current age. The result is the percentage of your portfolio that should be in stocks, the gas. The remainder, your age, is the percentage that should be in bonds, the airbags. If you are 20 years old, 100 minus 20 equals 80. You should be 80% stocks, 20% bonds. If you are 60 years old, 100 minus 60 equals 40. You should be 40% stocks, 60% bonds. The aha moment comes when you realize why this works. When you are 20, you have decades of income ahead of you. If the stock market crashes and drops 50%, it doesn't matter. You don't need the money yet. Your car is durable. You can afford to slam on the gas because you have plenty of time to recover from a crash. You want growth. But when you are 70, you don't have time to recover. If the market drops 50% the year you retire and you are 100% in stocks, you are ruined. You might have to go back to work. At 70, you don't care about going fast. You care about arriving safely. The rule automatically shifts you from growth mode to safety mode without you having to make a single emotional decision. Now that we understand the vehicle, how do we actually drive it? Step 1 is the easy first step, the birthday audit. You need to look at your investment accounts, your 401k, your IRA, your brokerage, and figure out what you actually own.
Here is a joke for you. Humans will spend 3 weeks researching which air fryer to buy to save $10 on chicken wings, but they will dump their entire life savings into a fund called the Aggressive Growth 2050 Fund without ever reading the prospectus or knowing what is inside it. We treat our life savings with less scrutiny than we treat a Yelp review for a taco truck. You need to log in and look at the pie chart. If you are 30 years old, the rule says you should be 70% in stocks. If you look at your account and see you are 100% in cash or 100% in crypto, you are doing it wrong. you need to calculate your current percentage. Step 2 is the secret step most people miss, defining stocks and bonds. When I say stocks, I do not mean you should put 70% of your net worth into GameStop or Tesla. That is not investing. That is gambling with a better user interface. In this rule, stocks means a total stock market index fund. You are buying a tiny slice of every public company in the world. You are betting on capitalism itself. Bonds means a total bond market fund. You are lending money to the government and stable corporations. The secret is simplicity. You only need 2 funds, one stock fund, one bond fund. That's it. You don't need a portfolio of 30 different tickers. The 100 minus age rule works best when you are broad and diversified. You aren't trying to find the needle in the haystack. You are just buying the whole haystack and waiting for the price of hay to go up. Step 3 is the maintenance step, the rebalancing ritual. This is where the magic happens. Once a year, preferably on your birthday, because it reminds you that you are getting older and closer to death, which is a great motivator for financial planning, you adjust the percentages.
Let's say you are 30. Your target is 70% stocks, 30% bonds. Suddenly, the stock market goes on a crazy run. Your stocks double in value. Now, without you doing anything, your portfolio is 90% stocks and 10% bonds. You are drifting. You are taking too much risk for your age. On your birthday, you sell some of the high-flying stocks and buy more boring bonds to get back to 70-30. This forces you to do the one thing every investor tries to do but fails at: sell high and buy low. You are selling the thing that just went up, stocks, to buy the thing that is cheap, bonds. And when the market crashes, you do the opposite. You sell the stable bonds to buy cheap stocks. The rule forces you to be a genius contrarian, even if you are actually just following a math problem. Now, we have to do the reality check. I can hear the aggressive investors typing in the comments right now. You might be thinking, John, 100 minus age is too conservative. People live longer now. If I am 30 and I have 30% in bonds, I am losing money to inflation. Bonds yield nothing. I want to be 100% stocks until I die. This is the most common objection, and it comes from a place of greed known as recency bias. The rebuttal is simple. You think you have a high risk tolerance because you have only seen the market go up. Everyone is a long-term investor until they lose 40% of their net worth in 3 months. When the market crashes, and it will, the psychological pain of seeing your life savings evaporate is real. If you are 100% in stocks, you are much more likely to panic sell at the bottom. The 30% in bonds isn't there to make you rich, it is there to keep you sane. It is the psychological anchor that prevents you from jumping off the ship during the storm.
Furthermore, the rule of 100 is a baseline. If you feel spicy, you can modify it to the rule of 110 or rule of 120, 120 minus age. If you are 30, 120 minus 30 is 90% stocks. That is fine. But the principle remains the same. As you age, you must slide towards safety. The tragedy of the stock market isn't young people losing money. They have time to make it back. The tragedy is the 65-year-old who was 100% in equities in 2008, lost half their portfolio right before retirement, and had to work at a greeting card store for another 10 years. You do not win the game of money by getting the highest score on the leaderboard. You win by not crashing the car before you reach the finish line. The 100 minus age rule ensures that you slow down the car exactly when you need to, so you can actually enjoy the money you spent a lifetime accumulating. It turns investing from a terrifying daily gamble into a boring, automated process that runs in the background of your life. And that is exactly where money belongs, in the background supporting your life, not in the foreground consuming your anxiety.
So, to summarize, subtract your age from 100 to find your stock percentage, buy broad index funds to fill those buckets, and rebalance once a year on your birthday to force yourself to buy low and sell high automatically. Anyway, I'm collecting donations in the form of subscribes to fund the next video.